Hey everyone, welcome back. You would have no doubt heard about mutual funds, managed funds, ETFs, and index funds if you have started looking into investing. And sometimes as a new person, they can be quite confusing. Sometimes even for people who have been investing for a while, they don't know all of those options. So in this video, we will explore what these options are and how best they can fit in your investment strategy. Let's first begin with the similarities. All of these are examples of investment funds. As an investment fund, the idea is that investors pool their money collectively and use it to invest to get better returns. For example, you would have heard of the S&P 500. That lists 500 companies in the US. If you are to invest in that, you will need to go buy 500 different companies in different ratios, and that will be a lot of money, a lot of time, and a lot of brokerage costs. By investing in a fund, the idea is that investors can pool their money collectively, give it to a fund manager, who will then, on their behalf, go and invest that fund. In return, the fund manager charges a fee. So basically, investors get a chance to buy 500 companies at a very small price, for example, $500 or $1,000, sometimes even less if possible. And they can then use that fund to get better returns for themselves. The fund manager earns the fee, investors better returns. It's supposed to be a win-win situation. So this is where the similarities are. Now let's go into each one of them. Mutual funds were the first type of investment fund which came in Europe, in the US over a century ago. And these funds basically collected people's money and started investing as per their mandate. So typically, one thing to note over here is mutual funds typically are associated with active funds. In an active fund, a fund manager actively goes and invests in securities, for example, a certain class of shares which investors want, maybe property, maybe bonds, or whatever the mandate is. And they basically try to beat the market, try to get better returns than the benchmark for their investors. So when the mutual funds came around, they offered investors something which they had not had before, a chance for professional management and to be able to make returns on a small amount of investment. Instead of having a few $100,000 to invest in securities all across a portfolio that you want to do, you might be able to do it with just a few $1,000s or a few $100 in some cases as well. So they were very good from that angle. They allowed you to get a better exposure, better returns, better management. So it was a win-win for everyone. But what are the things you need to note? One, in a mutual fund, they are issued by the fund manager itself. So it's not like you can go to someone and get them. For example, you might have heard of Vanguard, BlackRock iShares, or in case of Australia, you might have heard of Beta shares as well. So these are examples of fund managers out there. In case you want to invest in the fund, you have to go fill out a form, give them the money. They will issue you the units at the end of the day. Whatever the value of the fund is at the end of the day, that's what they give you. And if you want to take your money back out, you will have to go fill out another form and they will give you the money in a few days. So there's a bit of admin involved in trying to get into these funds, and they are, because of the time delays, they're not extremely liquid, like in terms of you have to wait for a few days to get your money back or to put money in. Plus, you cannot invest in the middle of the day because whatever happens at the value which is at the end of the day. Now let's talk about managed funds. What are managed funds? Managed funds is another name for mutual funds. So if you ever hear the word managed funds, do not get confused. It's the same as mutual fund. It's just that certain parts of the world, such as Australia, like to call it straight away as a managed fund instead of mutual funds. But the idea is the same. Two words, same thing. Now, let's discuss the darling of every other investment advisor out there when you look on the social media. ETFs. Everyone tells you to invest in them. But what exactly are they? So in case of ETFs, instead of you going to a fund manager to get units, the fund manager actually lists the unit as a security, as a share on the stock market. What that means is you can literally go and buy them on the stock market similar to a share. You can trade in them all day. Their pricing is live. So if the underlying security moves, their value keeps moving. So it allows you to trade instantly. And if you want to exit similar to a share, you can instantly sell it and then get your money back. So what it did was it gave you the benefit of a share or a stock and an investment fund. These are ETFs, exchange traded funds. The other advantage with ETFs is it's transparent. Because the securities are being updated live, you can know the value at any point in time during the trading day. So instead of waiting till the end of the day to invest in a mutual fund, finding out the NAV, the net asset value, you can literally do it throughout the day with transparent pricing. So that's a massive advantage which ETFs have. Another advantage can be in the form of fees. If, for example, you go to the website of Vanguard Australia and you look at their ETF called Vanguard Australian Shares VAS, you will see it also has a managed fund. But the managed fund is a higher fee. And that could be down to different factors such as the fund size, because the ETF is growing massively compared to the fund itself. So that allows it to have lower fees, and there can be other factors, but that's something to look at when deciding which one to invest in. Now, before we move forward, if you're liking the video so far, please consider giving it a thumbs up and consider subscribing. Now let's move on. Index funds, the darling of financial influencers. So what are index funds? I did a detailed video on that if you want to check it out, but briefly, index funds simply track an index instead of trying to actively manage the securities. So like the S&P 500, it will just go and buy those securities and hold on to them instead of trying to find other opportunities. The idea being in the long run, these give you good returns because you are literally tracking the index or the market. So they're very popular. They're supposed to be safe investments, supposed to be very low cost. So they have become really popular. So in terms of index funds, the thing to remember is it's not a separate fund. It will be either in the form of a mutual fund or in the form of an ETF. Typically, mutual funds are supposed to be active, but you will find them to be following an index such as on Vanguard, or you can find ETFs which are traditionally supposed to be following index funds, but you can find some active ones as well. But typically, index fund is just a form of investment which the funds are tracking. Now, I hope this is making sense, but I'm sure you might have more questions, so it might be worth checking out one of my other videos which might give you more information in your investment journey. But until next time, have a good one. Bye.